Alright, so now let's continue our discussion for budgeting, and we'll focus on what's referred to as the master budget. So what is the master budget? The master budget is an integrated set of operating and financial budgets for a period of time. Most companies prepare a master budget on a yearly basis. So every year they have to set a master budget. So remember, the master budget has two components, the operating budget and the financial budget. So in this video we'll focus mainly on the operating budget with its components. In the following video we'll cover the financial budget. So the master budget begins with preparing the operating budgets, which form the budgeted income statement. In the following exhibit, Exhibit 6, it shows that the operating budget can be used to prepare a budgeted income statement, while the financial budget provides information for a budgeted balance sheet. And then the following exhibit, Exhibit 7, shows the relationship among the operating budgets leading to an income statement budget. So let's see that. So again, we have two under the master budget. For a manufacturing company, we have operating budget and we have the financial budget. Under the operating budgets, we have things like the sales budget, the cost of goods sold budget with its component, things like the production budget, the direct material purchases budget, direct labor cost, factory overhead, and the selling and administrative expenses budget. So when we put all these together, we'll be able to prepare the budgeted income statement. This budgeted income statement can help in preparing the budget balance sheet as well as the financial budget. So the financial budget, with the help of the budgeted income statement, help us prepare the budgeted balance sheet. And under the financial budget, we have the cash budget and we have the capital expenditure budgets. So in this video right now, we're going to focus on the operating budget. And in operating budget, we start with the sales budget, which would have an impact on the production budget as well as the selling and administrative expenses budget. And then once we have the production budget, we have to decide on the direct material purchases budget, direct labor cost budget, and the factory overhead cost budget. Once these are done, we prepare the cost of goods sold budget, and then with the help of these, the cost of goods sold and the selling and administrative expenses, we can prepare the budgeted income statement. So in the coming slides, or the coming part of the video, we're going to be going over each one of these budgets and try to understand how it's prepared. But remember, we're doing all these sub-budgeted budgets in order to be able to prepare the budgeted income statement. So operating budgets, the integrated operating budgets that support the income statement budgets, are illustrated for a company called Elite Accessories Incorporated, which is a small manufacturing company of personal accessories. So we're using this company as an example to apply the operating budgets and the financial budgets. So one of the first operating budgets or parts of components of the operating budgets is the sales budget. So the sales budget begins by estimating the quantity of sales, and the prior year sales are often used as a starting point. So we get last year's sales, and using last year's sales, we make some adjustments to make an estimate of the quantity of our sales. So these sales quantities are then revised for such factors as planned advertising and promotion, projected pricing changes, and expected industry and general economic conditions. Once sales quantities are estimated, the budgeted sales revenue can be estimated or determined as follows. So we can get the expected sales volume and multiply it by the expected unit sales price to get the budgeted revenue. So now let's apply this example on the sales budget. So Elite Accessories Incorporated manufactures wallets and handbags that are sold in two regions, the East and the West regions. Elite Accessories estimates the following sales volume and prices. So they have the wallets, they have the handbags for the East region, the West region, and the selling price is the same for both regions, which I think would simplify our process. In some examples, we might find that the selling prices might differ from one region to another. It's not going to complicate things too much, but we just want to make sure that we're using the correct selling price for each region. So with the help of an Excel sheet or a spreadsheet, we can create the sales budget as follows. So we have the product and region, So we have wallet and we have the handbag, and each one of them is for the east and west, and then we calculate their total, and then when we combine the subtotals, we get the total revenue from sales. And then we have a column for the unit sales volume and another column for the unit selling price. Notice that the unit selling price for each region is the same, like east and west is the same. If they're different, we can simply just change these numbers. And then we get these total sales by multiplying the unit sales volume by the selling price for each region and product. So we got 6.3 million for the wallets and about 7 million for the handbag. And the total for that is $13,336,000. So once we have the sales budget, we can prepare the production budget. The production budget should be integrated with the sales budget to ensure that production and sales are kept in balance during the year. Because if we overproduce or we underproduce, again, that can have an impact. If we overproduce, then we'll have a lot of ending inventory than we need, and then that can create a problem with storage. If we underproduce, then we are not going to satisfy the demand for our products. So the production budget estimates the number of units to be manufactured to meet budgeted sales and the desired inventory level. Keep in mind that there's also a desired inventory level, like an ending inventory level. We don't want to have production to be exactly as our sales, because this would end up having no buffer, and sometimes we need to have some kind of buffer or a backup. So the budgeted unit to be produced are determined as follows. The expected units to be sold, and that we add to it the desired units in ending inventory. So our expected sales plus the desired inventory minus the estimated units in our beginning inventory would give us our estimate for the total units to be produced. So going back to Elite Accessories, the company expects the following inventories of wallets and handbags. At the beginning of the year, they expect these values for wallets and handbags, and then the end of the year, that's their desired inventory. So they want the inventory to be about 80,000 for wallets and 60,000 for handbags. So the production budget, again using an Excel sheet, would be very simple. We get the number of units here for wallets and handbags. We expected units to be sold, the desired ending inventory. We add them together, we get the total units available. And then we subtract the beginning inventory, or the estimated beginning inventory, to get the total units to be produced. Keep in mind the production budget only relies on number of units. There are no dollar values. If I go back to the previous slide here where we had the sales budget, we had dollar values because we're relying on sales and the selling price. But in the production budget, everything is just number of units. There are no dollar values. Once we have the production budget, now let's break it down to material, labor, and overhead. And we'll start with the material. So direct material purchases budget. The direct material purchases budget should be integrated with the production budget to ensure that production is not interrupted during the year. So the direct material purchases budget estimates the quantities of direct material to be purchased to support budgeted production and the desired inventory levels, and can be developed in 3 steps. So we can develop these direct material purchases budget using the following 3 steps. The first step, we determine the budgeted direct material required for production, which is computed as follows. We get the budgeted production volume, and we multiply it by the direct material quantity expected per unit. And that will give us the budgeted direct material required for production. So let's go back to our example, which is the Elite Accessories Incorporated. So the company uses leather and lining in production wallets and handbags, and the quantity of direct material to be used for each unit of production would be as follows. So for leather, we have the wallet, or for the wallets, we use leather and lining. For the leather, it's about 0.3 square yards per unit, and the lining, it's 0.10 square yards per unit. The handbags use a little bit more, so it's 1.25 square yards per unit for leather, and 0.50 square yard per unit for the linings. So for the wallet, the direct material required for production is computed as follows. We get the number of units that we want to produce, which is 520 units. And let me go back to show you where we got this value from, which is the total units to be produced, the 520 here. That's for the wallets, and remember 292 for the handbags. So we got the 520 units multiplied by 30 square yard per unit, and that would be 156,000 square yards of leather. And for the lining, it's the same thing. For the 520 units multiplied by 10 square yards per unit, the total would be 52,000 square yards. For the handbag, the direct material required for production is computed as follows. We get the 292,000 units multiplied by 1.25 and multiplied by 50 square yards per unit based on leather and lining, and we get these values. In the second step, the budgeted material required for production is adjusted for beginning and ending inventories to determine the direct material to be purchased for each material as follows. And again, I hope this is logical. We start with the step number 1, where we have the materials required for production. We get these values, which is what we just calculated here. Then we add the desired ending material inventory, and we subtract the estimated beginning material inventory that's already available. That will give us the direct material quantity to be purchased. So let's apply that. And then in step number 3, the budgeted direct material to be purchased is computed as follows. We get the direct material quantity to be purchased from step number 2, and we multiply it by the unit price. So the following inventory and units price information for the company were as follows. So we have the estimated direct material inventory at the beginning of the year. These are the direct material inventory, or the desired direct material inventory at the end of the year. And then the estimated price per square yard of leather and lining during the year 1. And we have the price as $4.50 for the leather and $1.20 for the lining. So we rely on an Excel sheet. Excel sheets make our life much easier. Remember, now we're just doing the direct material purchases budget. It involves dollar values because there are unit prices that we're going to be used. So we'll start with the square yards required for production for the wallets and the handbags. And here, based on leathers and linings, and here are these two notes showing the calculations, which are basically the same as what we have done here. Okay, so these two values, or actually 4 values, are represented here again in the bottom part of the Excel sheet. So we get the 156,000, the 365,000, the 52, and the 146. We add to that the desired ending inventory of material, okay, 20,000 and the 12, which were also given to us here, okay, the desired values for the leather and the linings. And that will give us the total square yards available, 541 for the leather and 210 for the linings. And then we subtract the estimated inventory at the beginning of the year. And that's 18,000 for the leather and 15,000 for the lining. So that would give us the total square yards to be purchased, 523 and 195 for the leather and the lining respectively. We multiply by the unit price of each, and we get the total direct material to be purchased, $2,353,500 and $234,000. We add them together and we get the total direct material purchases budget, which is $2,587,500. Now let's move to the direct labor cost budget. The direct labor cost budget estimates the direct labor hours and related costs needed to support budgeted production. Production managers study work methods to provide estimates used in preparing the direct labor cost budget. The direct labor cost budget for each department is determined in 2 steps. So unlike the direct material, it was 3 steps, here it's only 2 steps. In the first step, we determine the budgeted direct labor hours required for production, which is simply calculated as the budgeted production volume multiplied by the direct labor hours. The budget production volume, we already had that previously calculated, and we multiply it by the direct labor hours expected per unit. So for our example, Elite Accessories production managers estimate the following direct labor hours to be needed to produce a wallet and a handbag. So we have 2 kind of labor we need the cutting and we have the sewing. So the cutting department and the sewing we have here for the wallet and for the handbag. So the budget direct labor hours required for production of the wallet would be as follows. For the cutting would be 520,000 units multiplied by 10 cents per hour. That would be 52,000 direct labor hours. And for the sewing, 520,000 units multiplied by 25 hours per unit. I'm sorry, these are not cents. These are quarter of an hour per unit. That's the time consumed for sewing. That's 130,000 direct labor hours. So the budgeted direct labor hours required for production of the handbag would be done very similarly. Instead, we're using the number of units to be produced by the budgeted hours per unit. And we get the direct labor hours for the cutting and for the sewing. In the second step, we determine the total direct labor cost, and this is basically the direct labor required for production multiplied by the hourly rate. And here where we involve the dollar values. And the cutting department hourly rate is $12, for sewing department is $15. Again, we use another Excel sheet, and that would make our life much easier. So we have the direct labor cost budget, the hours required for production, we have for wallet and the handbag, and here we have the note, just explains what we just went over here in the previous slide. These two parts, again, they're repeated here on the Excel sheet. So we get the hours required for production, 52 for the wallet for cutting, or 52,000, 130,000 wallet for sewing, and then for the handbags, 43,800 for cutting and 116,800 for the sewing, multiplied by the hourly rate, which is the same for both cutting, or actually for whether it's wallet or handbag, but it's $12 for the cutting and $15 for the sewing. We get a total of $1,149,600 for the cutting and $3.702 million for the sewing direct labor cost, and the total would be for about $4.85 million. So now we are done with the direct labor cost budget. Now let's move to the factory overhead cost budget. So the factory overhead cost budget, I think it's slightly simpler because these are just estimated values based on previous years. So the factory overhead cost budget estimates the cost for each item of factory overhead needed to support budgeted production. The factory overhead cost budget would be shown in the next exhibit, may be supported by department schedules. Such schedules normally separate factory overhead costs into fixed and variable costs to better enable department managers to monitor and evaluate costs during the year. The factory overhead cost budget should be integrated with the production to ensure that production is not interrupted during the year. So let's see this Excel sheet here. It shows us the factory overhead cost budget. We have the indirect factory wages, we have the supervisory salaries, we have power and light, depreciation, we have the indirect material, we have the maintenance, we have insurance and property taxes, and then we get the total, and the total factory overhead cost is $2,089,080. Once we're done with the factory overhead cost budget, we are ready to calculate or present our cost of goods sold budget. So the cost of goods sold budget is prepared by integrating the three things that we just prepared. The direct material purchase budget from Exhibit 10, the direct labor cost budget from Exhibit 11 or Table 11, and the factory overhead cost budget, which is the previous table, which is Exhibit 12. The estimated and desired inventories for direct material, work in process, and finished goods must be integrated into the cost of goods sold budget. So going back to our company, Elite Accessories, it expects the following direct material, work in process, and finished goods inventory. So here we have the estimated inventory, and we have the desired inventory, and we have that's for the leather, for the linings, and then that's for the material, and then the work in process and the finished goods. So we'll need to prepare another Excel sheet. The Excel sheet would be a little bit intense for the cost of goods sold. Keep in mind we need to have 3 columns we're going to rely on the budgets that we prepared for material, for labor, and for the overhead. So we start with the finished goods inventory at the beginning of the year, January 1st, year 1. So we get this value. Then we get the second line would be the work in process inventory for, again, the beginning of the year. And for that work in process, we have the direct material, we have the direct labor, and we have the factory overhead. Direct labor and the factory overhead, these are straightforward numbers that we're going to get from the previous tables. But for direct material, we have to consider that we have beginning material, we have material that we purchased, and then we have to subtract the desired ending inventory for material. So the direct material inventory for the beginning of the year was 99,000. The direct material purchased from Exhibit 11 or Table 11 was this value. Adding them together, we get the cost of direct material available for use. Then we get the direct material inventory at the end of the year. This is going to be subtracted from what was available to get the cost of direct material placed in production. So this number here, the 2.582 or the 2,582 and $100 plus the direct labor plus the factory overhead, these three numbers added together would give us the total manufacturing cost, which is 9,522,780. We add this number to the work in process that was in the beginning of the year to get the total work in process during the period. So now it's 9,737,180. Okay, and that's why it's important to have three columns. Now, since we have this, we subtract the work in process inventory, which is the 220, and that's the end of the year, work in process. So now we get the beginning work in process plus the total work in process, like the work in process during the period. We subtract the ending work in process to get the cost of goods manufactured. Cost of goods manufactured is going to be added to the finished goods inventory at the beginning of the year. And that would give us the cost of finished goods available for sale. So these two numbers added together would be the 10,612,780. Then we subtract the ending inventory, the finished goods ending inventory, which is 1.565, and that would give us the cost of goods sold. Remember, the finished goods inventory, that's a desired value. We are the ones who decide on that. Okay, so most of the finished goods, these are, so same thing with the finished goods for the material. The direct material inventory, December 31, year 1, the 104,400, that was a desired value. That's something we decided on. So we got the cost of goods sold, and that was, again, an important part for the income statement. The next thing is to calculate the selling and administrative expense budget. Remember, the selling and administrative expense budget is directly related to the production budget, so or the sales budget. So the sales budget is often used as the starting point for the selling and administrative expense budget. So remember, when we have the sales budget, and let me take you back to that chart. When we have the sales budget, this is what we start with. It has an impact on the production budget, and it also has an impact on the selling and administrative expense budget. See these two arrows here? These are the two main budgets that are impacted by the sales budget. So the sales budget is our starting point. It's very important to remember that. So going back to selling and administrative budget, is often used as a starting point for the selling and administrative expense budget. So for example, a budgeted increase in sales may require more advertising expenses. So in the next exhibit, we will see the selling and administrative expenses budget for the company that we're using. The selling and administrative expenses budget is normally supported by departmental schedules. So for example, an advertising expense schedule for the marketing department could include advertising media to be used, like newspaper, direct mail, television, and the quantities like column inches, number of pieces, the minutes, and related cost per unit. So let's see here a simplified selling and administrative expense budget. So we have the selling part on the top where we have the sales salaries expense, we have advertising expense, we have travel expense, and we get the total, and that would be the total selling expenses. And then we have the administrative expenses consisting of 5 things, like officers' salaries expense, the office salaries expense, the office rent expense, the office supplies expense, the miscellaneous administrative expense. You get the total, and that would be the total administrative expense. So adding these two numbers, we get the total selling and administrative expenses. Once we're done with selling and administrative expense budget, we are ready to prepare the budgeted income statement. The budgeted income statement is sometimes called a pro forma income statement. You see this all the time with all publicly traded companies. They prepare something called a pro forma income statement, which is basically a budgeted income statement that relies on the sales budget, the cost of goods sold budget, and the selling and administrative expense budget. In addition, estimates of other revenue, other expenses, and income tax are also integrated into the budgeted income statement. The budget summarizes the budgeted operating activities of the company. So in doing so, the budgeted income statement allows management to assess the effect of estimated sales, costs, and expenses on profit for the year. So let's see this Excel sheet that will give us this kind of budgeted income statement. We start with the revenue from sales, and that's coming from the sales budget, which is table 8 that we prepared before. Then we have the cost of goods sold, which is the last table that we also prepared, table 13. And that's, again, the cost of goods sold budget. And we get the difference, we get the gross profit. Again, that's the budgeted gross profit. That's not the actual gross profit. Then we get the selling and administrative expenses. So we have the selling expenses, administrative expenses, add them together, and we subtract that total from the gross profit to get our budgeted operating income. Once we have our operating income, we add other revenues, other expenses, again, depending on the situation. And then once we get the net of these other revenues and expenses, so in this case here we have interest revenue, interest expense. It turned out to be a positive value. We add it to the operating income to get the income before tax. Then we subtract the income tax to get the bottom line net income. Again, that's not the actual net income, that's a budgeted net income. Alright, so I think this would require some practice because practice makes perfect. I know it's not, it's a lot of overlapping things, but just at least know the sequence of what we have been going through. Now let's go through a quick knowledge check and let's see this question. It says, which budget estimates the number of units to be manufactured to meet budgeted sales and desired inventory levels? Is it the direct material purchases budget? Is it the cost of goods sold budget? Is it the production budget? Or is it the selling and administrative budget? Again, which budget estimates the number of units to be manufactured to meet budgeted sales and desired inventory levels? So I think production budget, which is the next step that comes after the sales budget. So the production budget is the budget that would give us these kind of estimates for the number of units to be manufactured. So the production budget estimates the number of units to be manufactured to meet budgeted sales and desired inventory levels. The production budget should be integrated with the sales budget to ensure that production and sales are kept in balance during the year. Right, so let me stop here. In the next video, we're going to be going over financial budget.